Hey guys, it's Matt, and if you want to be rich, stop investing in dividend stocks.
But Matt, I saw a video on TikTok where someone said I can make passive income from dividends.
Well, see, that was your first mistake. Getting financial advice on TikTok, I mean. But your second mistake was believing that passive income is a real thing. Now, don't get me wrong, I have nothing against dividends, and I think they're a great part of every investment portfolio. But there's a lot of common mistakes and misconceptions that investors have when it comes to investing in dividends and making the right decisions about them. So for the next few minutes, let's talk about these mistakes, misconceptions, get Warren Buffett's dividend investing advice, and see if dividends are the right fit for you, if at all. But quickly, if you haven't already, make sure you're subscribed to me down below because it really helps out the channel. And with that, let's get into it. Now, to understand why dividends might be bad, we have to break down what they are. Dividends are a way that companies can share their profits to shareholders. For example, let's say Matt stock is trading at $100 a share and I have a dividend of 10%. That would give you $10 every year from just holding my share. Now, that probably sounds great, but it's important to note that this money doesn't just come out of thin air. It doesn't grow on trees, unfortunately. I know. Crazy, right? If a company is paying out dividends, it basically means that they think they have no better use for that money, so they give it to you. Now, this is where it can get confusing. That might seem like a good thing. The company has so much money that they're willing to just throw it away to you. But that's not exactly how it works. It's time to use those critical thinking skills of yours. A company should be investing their money back into the business to grow and expand. And if they aren't, that can mean one of two things. Number one is the possibility that maybe they have future restricted growth, meaning they already dominate the market and can't increase their competitive advantage. Or it's option number two, and the company is incompetent and likes throwing money away. And for your sake, if you're holding any dividend stocks, I hope it's option number one. And if you don't believe me, here's a clip of Warren Buffett explaining his thoughts on dividends.
Dividend policy should really be determined by that criteria, also bearing in mind the possibilities of repurchase of stock too, but they should be determined by whether a dollar left in the business is worth more than to the shareholder than a dollar paid out. Someplace like Coca-Cola, if Coca-Cola had paid no dividends and simply repurchased shares and developed the bottling system and done the things that they have, the shareholders probably would have been even better off. They've been sensationally well off as it is, but they probably would have been even better off than they have been with the dividend policy they have had.
I may only have 150 subscribers, and this video might have less likes than you have fingers on your hands, but that man is the greatest investor of all time. Aside from Jim Cramer, of course. So take it from him. Now, dividend stocks aren't necessarily bad, but you can be bad at investing in them. What do I mean by this? Well, think back to the two main conclusions we can draw from dividend-paying stocks. Number one is that they are restricted in their future growth, and number two is that they're just incompetent. If you're an investor looking for growth, perhaps you're younger, maybe able to take on more risk and volatility, and really want to maximize the potential profits you can have, you'll want to look into companies that still have room to grow and can increase their competitive advantage. Investing into an already massive company like Coca-Cola or Apple may not provide you with the returns that you want. While these companies are wildly successful and probably will be for a long time, they've already had their runs and already dominate their market, which is why they have so much cash on hand that they don't mind throwing it away to you. Younger, newer, and faster growing companies are more likely to keep that cash to reinvest back into their business operations. Now let's move on to another benefit that people like to talk about as to why you should own dividend stocks. Dividend stocks also tend to be more stable, which is why they're great for older people and people in retirement to get that steady stream of cash flow while having less volatility in their portfolio. But the reason they're more stable is because of a couple things. The first is expectation. Investors know that they're going to receive a dividend at the end of every year, so it makes the investment a little safer. The second is dividend reductions. Companies are very unlikely to reduce their dividends because markets tend to not act kindly towards them. This gives investors confidence that the dividend payments will continue indefinitely, either at the same amount or potentially greater amounts. Now that you understand the general idea of dividends, let's debunk some of the common misconceptions that investors have about dividend stocks. Number one, You aren't actually making money when you receive a dividend payment. This is because the company is reducing its cash on hand when it pays out the dividend, which is reducing the value of the company. So the stock actually drops by the amount that is paid in the dividend payment. This leads me to number 2, which is when people say,
I'm just gonna reinvest the dividend payment back into the company.
This is just stupid. You're likely taxed when you receive those dividends, so by reinvesting them back into the company, you're just taxing yourself twice. And the stock price of the company just fell by the amount of the dividend payment, so you're actually just losing money because of taxes. Alright, you still with me? Because now we get to decide if and how you should invest in dividend stocks. And it's pretty easy, because there's really only one scenario in which you should specifically invest in dividend stocks. And that is if you want less volatility, need the cash flow, and plan on reinvesting the dividends back into a different company. If that criteria doesn't fit you, then dividends are not for you. Now again, this doesn't mean you should go out of your way to avoid investing in dividend stocks altogether. It simply just means that you should avoid going out of your way to only invest in high dividend yielding stocks. A lot of companies pay average dividends, so if you buy into an index fund or an ETF, you'll likely still receive some sort of dividend payments, which is great. But don't build your investment portfolio specifically surrounding dividend stocks if your investing style doesn't match the benefits that they provide. Anyways, that's about all I have for you guys today, so make sure to subscribe if you haven't already, and until next time.